I don't know how big it's going to be. In terms of percentage, well, I think gold was like 20, maybe 25% from the top, maybe in February 2020 or early March 2020 to wherever it stopped at 1450. I think it was like maybe 1800 down to 1450. What percentage is that? It's something like 25% and I don't think I'm wildly off there. I'm just not doing the math in my head. So, I mean, we could see something like that. What's 25% of, let's say, 3600? About $700 down. So could I see a crash in gold to like maybe 2800, 2900 and real panic on a repo crunch? Yeah, it's possible. But most of my positions were established way before 2800. So, unlike 2020, which really got me, my heart pumping in a bad way and, sweating, I held on. But this one, it would be like, a little bit, like a mild roller coaster, like something I could handle. Since 2024, I think, the beginning of 2024, we've had a few consolidations in gold. There are many different ways to count a consolidation. You can debate where you want to start counting, where you want to stop counting. But if we just take just a general idea of what a consolidation is, the price doesn't go beyond a previous high, then the average length of a consolidation since 2024 has been about 4 months. There's been one that was 3 months, and usually the rallies are between 1 and 2 months. So the rallies are shorter in time span than the consolidations. That's how it's been. Doesn't mean that's how it always will be, or that's how it necessarily will be this time. But nothing fundamental really has changed since the beginning of 2024. We're still operating on the leftover printing from 2020. We're almost out now, finally, but we're still operating on that, so it's the same basic monetary structure. So based on that, it just seems like there's a good chance here that the consolidation in gold is pretty much over, and once we pass 3500, we should start seeing the next rally, which shouldn't take too long in time span. Should be about 1 or 2 months until we get to a new plateau. Could be 4,000, could be higher than that. It's hard to tell exactly where it'll stop.
Despite lingering consolidation, underlying fundamentals remain powerful. Central banks continue to accumulate gold as a strategic reserve. In Q1 alone, global demand by value neared record highs, driven by geopolitical tensions, a weakening dollar, and rising tariffs. These institutional flows lend depth to any rally that might unfold soon.
But in the meantime, we also have to look out for the end of the last tranche of 2020-2021 money printed fuel. And because we have now still about $100 billion left in reverse repos, which is the backup money supply that comes in every so often, that's still going to run out. And when it does, the Fed is going to have to print again, because all of the extra reserves are still being used in the plumbing of the system, and they can't be double booked. They can only go in one direction. And all of the hedge funds and everything like that uses that money, they need that to keep coming, or they have to close their trades, and that could cause a systemic toppling. So before that runs out, we should see gold start to rally, and I'm not discounting that gold and silver will get hit, perhaps severely, though less severely than most other things, in the event of some kind of a clog in the plumbing. But that's only going to be like, a few days until the Fed responds, and then we should see a slingshot. So I'm not counting that as part of the trendy consolidation versus rally. That's something else. Like, for example, if you look at 2020, like February, March, April 2020 in gold, it was a humongous dip, and it was one of the worst dips in history for gold stocks. But if you look on a chart that's 5 years or longer, you don't even see it. It's not even there because it was so short. This one's going to be even shorter. It's going to be very scary, but it's going to be shorter. I don't know how big it's going to be. In terms of percentage, well, I think gold was like 25% from the top, maybe in February 2020 or early March 2020 to wherever it stopped at 1450. I think it was like maybe 1800 down to 1450. What percentage is that? It's something like 25% from, and I don't think I'm wildly off there. I'm just not doing the math in my head. So, I mean, we could see something like that. What's 25% of, let's say, 3600? About $700 down. So could I see a crash in gold to like maybe 2,800, 2,900 and real panic on a repo crunch. Yeah, it's possible. But most of my positions were established way before 27, 2,800. So, unlike 2020, which really got me, my heart pumping in a bad way and, sweating, I held on. But this one, it would be like, a little bit, like a mild roller coaster, like something I could handle.
Gold's ascent in 2025 is being fueled by renewed global uncertainties. Geopolitical frictions, trade tariffs, and waning U.S. job growth have catalyzed bullish sentiment. Analysts now anticipate prices could push toward 3,500 to 3,600ers in coming months. Such optimism aligns with a broad shift towards safe haven assets across markets.
And I'm sure most of your followers could handle it too if they got in before 27, 2,800. So it'll be difficult, but it won't be a 25% dip from here wouldn't affect most of the stackers as a 25% did from 1,800 to 1,450. So it could be a similar breadth or a similar move percentage wise, but I don't think the stackers are going to be fooled like they were last time. From what I understand, and I queried some AI on this just to make sure I'm right. I don't use them for my primary research, but I check my conclusions with AI to see if there's something wrong with them. So this checked out, at least. So if you imagine what's happening in a margin trade, when let's say an institutional trader wants to increase his position for his clients, so he borrows on margin from the broker. The broker's got to get the dollars from somewhere. The broker gets it from the bank. The bank gets it from the repo market, at least, about half the time. So what happens is ultimately you have this loan that's secured by equities by the client to the broker, right? The broker pledges his securities, which he still owns, but the broker maintains his right to sell those securities by force if the margin loan can't be paid in time, if it gets called in. So that puts the client of the broker in danger of having his stocks force sold. And the broker itself has to pledge those securities to the bank, right? The same securities that the client pledged in, ultimately they're pledged to the bank. So the bank has to sell, it's really not up to the broker. The broker is just a middleman. The bank has to sell the securities so it doesn't get its dollars back. But where does the bank get its dollars? It gets its dollars from the repo market, for which the bank that's giving dollars ultimately lends the repo market every night treasury securities. So these margin positions are ultimately dependent on the treasury securities that are pawned off to the repo market to another bank to secure the dollars that some other bank has in reserve. So since people are always asking for more and more margin, as we see, I think Andy Schefman talked about this you interviewed him recently, and he was talking about how margin loans have exceeded $1 trillion. There's no significance of $1 trillion other than that we're base 10 humans because we have 10 fingers and 10 toes. So 1 trillion is a psychological number for us. But what's more significant is that the rate of increase in margin, the amount of margin debt outstanding that's ultimately secured by treasury securities, right, that the rate of that has been going up and up. The acceleration has been going higher and higher, and we've had 2 months of, I think, above 15% monthly acceleration, which you only had, I think, once in 2000, or 2 months consecutive 15% or higher, something like that. I know it's in the double digits, and it's among the highest months of acceleration in margin debt ever. So what happens is if the dollars run out in the repo market, right, and then the amount of interest that you have to pay, because it's supply and demand. If there's more demand for the dollars than there's dollars available, the interest on those dollars has to rise.
Structural strains in markets, such as repo market tightness or aggressive margin unwinds, could provoke swift price drops even in gold. As seen during the shock of early 2020, sharp but brief crashes may occur, followed by fast central bank intervention. Given this backdrop, any potential dip in gold could be steep but short-lived, ending in a dramatic rebound.
And that means that ultimately the client that's taking the margin, right, he has to pay higher interest rates. If he can't pay them, right, in order to pay them, you have to, because he has no cash in his account, otherwise he would be trading on margin. He's already fully positioned. so he can't pay those suddenly spiking interest rates. And then they had the broker gets called in by the bank, like, you have to pay me that interest because we're having a repo clog here, and the interest is going up on those daily, nightly repo loans. So you have to sell those positions and pay that interest. And then the bank said, but if everyone's doing that, everyone has to sell the positions, the value of the stocks that they bought on this margin loan are going to go down together because everyone has to sell it, pay the interest rates. Right? And then if the value goes down enough, then if it goes down enough, then they can't pay back the margin loan itself, the principal. If the value of the stock's being pawned off for the margin rate for the margin loan in the first place can't be pawned off, and then the bank itself gets in trouble because the bank is the one that pawned off the treasuries in order to get the cash in the first place to give to the broker to give to the client. So if the bank's treasuries get forced sold, so the bank has to sell those securities plus some of its securities that they secured with the other bank to get the dollars, then you have a whole bunch of treasuries being forced sold at the market in order to pay back these margin loans. So what you have is eventually, if it's allowed to go on long enough, let's say a few days or a week or two, which I don't think it's going to last that long because the Fed's not going to allow it, then you have the situation of stock positions being forced sold to pay back repo margin loans. And if the value is not enough because everyone's selling, then a lot of treasuries get sold in order to cover the repo loans where the stock values can't plug in the hole. So you have rising interest rates, short-term interest rates on the repo market, plus rising long-term interest rates if treasuries are being repossessed in order to pay back these repo loans, and everything's falling at the same time, which would include gold and silver and everything except the US dollar itself very temporarily until the Fed steps in, which is what it's going to have to do.
Looking ahead, major institutions foresee continued upside. Goldman Sachs sees gold reaching 3,700s by year-end, with upside to 3,880 under recession scenarios, or even $4,500 amid extreme geopolitical strife. Fidelity, JP Morgan, and others anticipate levels hitting $4,000 into 2026. These projections reflect gold's resilience in the face of policy shifts and global uncertainty.
And it could go either way. I don't know how it's going to play out, but I do have a strong feeling this is going to be the last time. As you go down the fiat process, crashes get closer and tend to get more intense. But the intensity also, on the one side, yes, they do get more intense. On the other side, the Fed becomes more aware that it's going to have to act sooner and sooner following any kind of sign of stress, which is what we saw in 2019 and in 2020. And I think we're going to see it again. So we're going to see some kind of intense move, but we're also going to see the Fed act very quickly, where in 2008, it took them, maybe, a few months. It depends where you count where the stress started. You could count it years, starting with the top in the real estate market in 2006. You could start it with the excess reserves or whatever they were doing in the banking system in 2007, where they allowed the Fed to pay interest on excess reserves. See, most people don't know that entire process, that entire set of rules was only instituted once the banks told Congress, look, we need the Fed to be able to pay interest on excess reserves to keep all these reserves out of the monetary system because otherwise everything's going to explode. That actually happened before the financial crisis even happened.
As gold hovers near new peaks, one thing is clear. Bullish investors should expect intensity. Buy on dips remains a recommended tactic as upward momentum persists. Yet when markets reach extremes, when exhilaration mingles with anxiety, that may signal proximity to a breakout. When gold's upward moves feel simultaneously uplifting and unnerving, that would mark the beginning of a defining leg in this gold cycle.
So you count it in many different ways, but however you count it, it took the Fed some appreciable amount of time to really get moving, right? In 2019, it was much less. It was like they saw repo going up and up for maybe a week or two before they moved. And then they only moved when it really spiked. And in 2020, they acted immediately. The Congress or whoever was in charge of locking down the planet said, look, we're going to do this. And the Fed says, okay, we'll print $4 trillion like in the next day. 2, 3, 4 days, whatever it was. So it's going to be very quick, but it's going to be very extreme. In terms of will it be felt in the stock market, I don't think for beyond a day or two in terms of nominal values, but once the printing starts this time, I think we're going to see gold and silver, especially silver, really start to move like in ways that are going to be scary even for stackers. Because if you put yourself in our situation, in order for silver to, let's say, move like 20-30% a day, right? When that happens, we're going to see some really scary stuff happen in the equity markets, happen in the bond markets. Prices, oil is going to start heading up. Commodities are going to start heading up, not as fast as gold and silver, but they're going to start heading up very scary. And we're going to feel like, happy, but, worried at the same time. That's when we know that we're really close. When our happiness is tempered by our own fear, even if we're in a good situation financially, which is, once you start feeling that, you'll know we're almost there. And I think that's going to start to be felt once the next printing round begins, whenever the last bits of monetary stimulus from 2020 finally run out. Should be in a few weeks now.